Well, he says he won't slash and burn, but the federal Treasurer is warning of a tough May budget to deliver a surplus next year. A drop in company tax alone has blown a $90 billion hole in tax receipts over 5 years. But some economists argue now is the wrong time to be tightening the purse strings. Neil Woolrich reports.
Come what may, the Treasurer seems intent on delivering a budget surplus next financial year.
There are compelling reasons why the economics of surplus in 2012-13 makes so much sense.
But some are wondering if that's prudent when the local and global economies are still looking vulnerable.
I don't think it's imperative that the government deliver a surplus for 2012-13. I think what really matters is that the financial markets can see a trend towards a surplus, and providing that's in place, then I don't think there'll be a major problem for the economy.
But the fact is that we are living in a different world. And the world in which we are living is one which puts a premium on governments in particular implementing strong medium-term fiscal policies.
Wayne Swan says delivering that much-promised surplus has become even more challenging, with company tax $90 billion lower over 5 years compared to the 2008-9 budget forecast. Capital gains tax last financial year $11 billion lower than its pre-GFC peak, and the mining investment boom still to translate into company profits.
Our economy is now some 7% larger than it was prior to the global financial crisis, but we've not seen a return in revenues in any proportionate way.
It's not the weakness in the economy, it's not that they've missed on those forecasts, it's more that you're seeing a bit less revenue coming in, even though you're seeing GDP growth that's fairly solid and a labour market that continues to look fairly tight.
That means budget cuts will need to be found if Wayne Swan is to make good on his promise.
I think it's certainly a dangerous time to be cutting back on government spending, and so that's a fairly risky approach. But the Treasurer has indicated that he won't be slashing and burning, and so hopefully, therefore, spending cuts will be kept to a minimum.
And former Reserve Bank economist Paul Bloxham questions whether it's necessary to deliver a budget surplus in such a tight time frame.
It means a contraction of the economy and a contraction from the public side of around 2.6% of GDP, which is the largest contraction we're likely to that we will see since the mid-1970s.
But Wayne Swan argues a tighter budget will give the Reserve Bank more room to stimulate the economy.
So our fiscal strategy ensures we won't be adding to price pressures of a strengthening economy experiencing a once-in-a-generation investment boom.
I think the real issue at the moment is that we need much lower interest rates. I think it's really the job of the Reserve Bank to be cutting interest rates at this point in time and providing stimulus from that angle, rather than relying on the budget to provide stimulus.
Some difficult choices ahead for both the Treasurer and the Reserve Bank Governor.